and we are recording. So, welcome to our first of two sessions on property and casualty insurance. And our special guest lecturer today is Brian Boak, who is with a firm of Singer Nelson Chalmers in Teaneck, New Jersey. As you can see on the screen, Brian has an extensive history in the insurance industry, first with Prudential, and now as an independent agent with Singer Nelson Chalmers. And what has most impressed me about Brian is the scope of experience and information and wisdom, I will say, about this whole field of property and casualty, something that the typical financial planner, and certainly in my area of expertise, life insurance, we very rarely acquire as well an expertise in property and casualty. So, what Brian is going to be doing in these next two sessions is talking to us about the things that he feels are most important for a financial planner and especially a CFP planner to be able to have a conversation with a client that inevitably is going to involve bringing in a specialist. But the financial planner's role is to raise issues, talk about risks that may not have been considered before. And one of the conversations that Brian and I will have is how to help clients not have the experience or concern that they become insurance premium poor. So, with that brief introduction, I'd like to turn it over to Brian. And one little anecdote that I would like to share is Brian brews his own beer, and from being a kitchen effort, is now on the verge of being a full-fledged business with Boak beer. So, Brian, why don't you start just telling us a little bit about Boak beer, and then we'll talk about property and casualty insurance.
Well, hello, Dick. Welcome, and thank you for allowing me to assist in your class. Uh, Boak's beer has been around actually for about 5 years now, and we're available in New Jersey and Pennsylvania. We make mostly Belgian beers and a little bit of British beers, mostly high alcohol beers, 7 to 10%, but we do have a 4% beer also. We start with a wheat beer. We have a Belgian double, a Belgian brown ale. We take that brown ale, age it with Jack Daniel's barrels of Madagascar vanilla beans, and then we have a 10% very hoppy imperial stout. So we're kind of all over the board in reference to beers.
I have a student who lives in Princeton, New Jersey. Where would she avail herself of Boak beer?
Well, they could go to the Boak's website or download the Boak's iPhone app, and there is a beer locator on there.
That's
And
great.
they could find the location that's closest to them. Um,
So,
in
is this
Princeton, probably the closest place would be Philly because I don't have good distribution in central southern New Jersey at the moment. But Philly is not that far away, so
so? I suspect that you may be changing careers at some point in the near future.
one never knows.
Well, let's talk about property and casualty insurance.
Sounds like a good thing. So, property and casualty is kind of the missing piece of financial planning because everybody says, "Oh, I got my trusts, I got my wills, I got my life insurance. My life insurance is in trusts. I'm all good to go." But they don't realize that if their house burns down and they're not properly protected, or somebody trips and falls on their property and it's their fault, they could lose all the assets that they set up and worked their life for. So property and casualty is a lot more important than people think. Today we're going to talk about a variety of different issues. We're going to get about halfway through this agenda right here. We're going to stop somewhere in between the home and the auto section. That's our goal to finish. So we're going to talk about some general information, some family information, how to gather personal information, discussion of assets and liabilities. Learn about businesses because there's a variety of reasons for that. In addition to just making sure that everything's properly protected, you know where all their exposures are so you can properly advise them. As I tell my clients when I walk in the door or a new person that I'm talking to, we're going to play a big game of 20 questions so I can get to know you better. The better I know you, the better I can advise you. And then we'll go talk about homes and condos and co-ops and rentals and stuff like that. And then in our next session, we're going to talk about other types of movable items, motorcycles, autos, motorhomes, the fancier items, jets, yachts, jet skis, and excess liability, a very critical thing where everybody says, yes, I have an excess liability policy. And you look at this person that's got 10 or $15 million in assets and they've got a $1 or a $5 million liability policy. And they go, that's not correct. And then we're going to talk about a little estate planning claim story that basically destroyed somebody's assets in one little item. So, shall we begin?
Absolutely.
So the first step is really to gather all their policies. And really, you don't want to get just their declaration pages, because the declaration page is just like a snapshot. It's like saying, give me your family history, and the person gives you a photo of all the people in their family. Well, that is a family history. It tells you, okay, we've got older people, we got younger people, but it doesn't give you any depth to the question. So you need to start asking questions. And by having the policies versus the declaration page, you can see who is actually the named insured. Is the named insured the person? That's fine. But it's not fine if that item is owned by a trust or an LLC. You want to see the additional insureds on there, which is maybe where that trust or LLC should be listed. And if it's not listed, that's a big problem. You see their exact coverages. Many of those things you'll see on the declaration page. What you need the policies for is to be able to see the limitations and the exclusions of the policy. And that's where people get caught up. There are many policies out there that have, well, basically all policies have a limitation on jewelry. And it's anywhere from $250 to maybe $5,000, maybe $10,000 worth of jewelry. But high net worth people may have significantly more than $10,000 worth of jewelry. It may just be one of their watches or part of the value of one of their watches. So you have to worry about that. And also artwork, antiques, and collectibles, silver, items like that also have limitations.
Ryan,
So you always want to find out what people collect.
a quick question for you. In your experience, what is the difference between what people recall as to the coverage limitations and exclusions versus the reality?
Nobody has any clue. They figure, I have insurance, I'm covered.
Okay.
And that's how it is. I have an excess liability policy, I'm covered. Yes, but you're worth $15 million and you have a $1 million excess liability policy. Do you feel you're covered? Maybe not. And they definitely don't know their exclusions. And two of the largest exclusions are flood and earthquake. And here being on the East Coast with Sandy just happening 6 months ago, a lot of people found out what their exclusions were and what their limitations were, even if they had flood insurance. Because people buy flood insurance, but with the regular FEMA program, you can only buy $250,000 worth of coverage for your building and $100,000 worth of coverage for your contents. And if it's a secondary residence, everything's covered at actual cash value, not replacement cost. So a lot of people found out at the wrong time, either I don't have enough coverage or I don't have any coverage. So doing a very comprehensive review allows somebody to find out before the claim that I need to look at something, or yes, I do understand that I am not properly covered and I have chosen financially to make a decision that I'm going to keep it that way.
Good. Thanks. That's very helpful.
And what our goal as advisors is to make the person aware of the exposure so that they are making the financial decision whether they want to protect that exposure or not protect it. If you don't tell them that there is an exposure that exists, you're making a financial decision for them that they don't know about, which could come back to be an E&O claim, errors and omissions claim.
Good.
So, as I said, you want to ask a lot of questions. And we have designed a questionnaire. What I did is about 12 years ago when I started working for Singer Nelson Chalmers, I developed this questionnaire form. And what I did is I took about a half a dozen companies' questionnaires and just combined them into one. I took all the good stuff and all the questions and all the information that I thought I would need, and I combined it into one questionnaire. We'd be happy to email it to any of the students if they want. My email address is at the end, actually at the beginning, or you can ask Dick for it and he'll give it to you. But asking all the proper questions is the key thing. And we continue to update and modify that questionnaire as we realize, oh, we need to ask this question. So we need to put that in there. So, but the more questions you can ask and the more answers you get, the better you can advise your clients. When the client says, why do you need to know that? Well, every little piece of information relates differently. Like I'll ask clients, what do you do for fun? And they're like, well, why does that matter? I said, well, it could be an exposure because somebody could be, I like to travel to remote areas. Well, one of the exposures there is if you get injured in a remote area, where are you going to be treated? Are you going to be treated in Zimbabwe for a bad broken back? You probably don't want to be treated there. You probably want to be treated in your hometown, your home vicinity, or New York, or somewhere, some major facility. So there is a program that you can buy that's very inexpensive that we call basically Get Me Home Insurance. It's a medical evacuation program that flies me home. But if I hadn't asked the question, what do you do for fun? Do you travel? I wouldn't have known to advise the person of that. And to fly home from Zimbabwe, if you need to have medical assistance to fly home, it could be $120,000. So most of us, that would be a rather rough price tag to pay. Some of the people you work with, they may be able to afford it, but they're sure not going to like the fact that they, for $300 a year, they could have avoided that $120,000 bill.
Great point.
Once you gather all the information from the client and you have all of your policies together, then what you want to do is you want to kind of compare it and see where there are gaps and differences. If the client tells you they collect a lot of items and you know what items you collect, you want to look to see if they have those items scheduled on the policy to have proper coverage. You want to see if there's exclusions on the policies for those type of items if they're not specifically named. One of the problems we run into is some of our clients have a lot of artwork. And somebody with a lot of artwork, a lot of expensive artwork, can actually, even if it's covered on the policy without being listed, can actually outstrip their contents coverage on the regular homeowner's policy. So you have to worry about that. A lot of policies have limitations for breakage. So if you've got a person that's got a China collection or a Hummel collection or any of the, or blown glass collection, breakage can be a real big issue. So you want to find out all those gaps in their insurance. And you can read through basically the exclusions will list everything that's excluded. And then you want to look through the type of policy it is, whether it's what's called a named peril policy, which means you're covered for the 17 or so types of claims that are on the policy, but anything other than those claims you're not covered for. There are certain standard exclusions, which is items like earthquake and flood and nuclear disaster and war and stuff like that. Those are on every policy. Some of them you can buy coverage for, some of them you can't. Then what we would recommend you do is you create a report. And what you do is you would detail what coverage they currently have, list any gaps that you discovered, and any recommendations in reference to how to best resolve that situation. And some of them there may not be a resolution, but most of them there are. But the key is making the client known of the gaps, so even if you don't have a solution, they can go back to their property and casualty agent and go, I understand I might have an issue here. What are your ideas? Since you're not a you're probably not a fully licensed property and casualty agent, you would not know every single item that's out there. So you want to work with all the other advisors in reference to the gaps. So you want to work with the attorney, you want to work with the accountant, you want to work with the investment advisor if you're not the investment advisor, and you want to work with the property and casualty agent because you're one big team in protecting this person. This client may not think of it as a team, but you are a team.
Right.
And
Let me
that's,
ask you a question about that, because one of the things I neglected to say in introducing you is that your firm fairly uniquely provides fee-based insurance audits when certain clients request it. What are the conditions under which a financial planner or their client would be looking for to pay for an audit as opposed to just taking it to their State Farm agent?
well, if somebody has, the classic example is if somebody has several homes, maybe cars in different locations, or is very high net worth, say 10 million or above, they really should have their insurance reviewed by somebody other than the agent that's writing it. Not that the agent that's writing it is not a good agent, but the agent that writes it may not ask all the questions. So by having somebody come in that knows nothing about the client, that is not going to sell the person any insurance, comes in, does an independent review, analyzes all the policies, and then goes back and delivers a report saying, this is your coverage, these are what I feel your gaps are, and these are our recommendations on how to resolve that. Go to your insurance agent or advisor or broker and discuss this with them because we feel you have some issues. That way you're getting an independent third-party opinion on your insurance. Thereby you are better protected from somebody who just gets comfortable with renewing your policy.
Is there a particular type of client for which you might recommend that a CFP planner actually proactively suggests that this would be the right situation for starting with a fee-based audit?
Uh, particularly if they have homes in multiple states and have multiple agents. That is usually the biggest problem
Okay,
because things are no longer coordinated.
great.
Or you're talking about somebody who's worth, say, 10 million or above because they probably have assets that may not be properly protected because they have collected items over time. So those are the two key things is homes and when somebody has policies with different agents, that's a blatant somebody else has got to review it because one person does not have a complete view of everything. And two, if they're worth 10 million or above, because they probably have stuff that may not be properly protected. And they may have started going into some estate planning where some of the locations may be transferred over to trusts. If they own multiple locations, they may have different usages. Their children or parents may be living in certain locations. So you want to make sure that everybody is properly protected. I've had times where I've done a fee-based review for somebody, and they told me, yes, we bought this condo in Florida under an LLC, and yes, it's listed on the policy. I said, okay, I understand you say it's listed on the policy, but from the paperwork you gave me, it's not listed on the policy. So go back and get me the rest of the documentation. So they sent me an email from the agent saying, yes, it's covered. I understand this email from 3 years ago says, yes, the LLC is on the policy. But I want something from, and this happened to be Chubb, I want something from Chubb saying the LLC is on the policy. And what happened is the agent told the company never put it on, the agent never checked up on it. So the LLC was not on the policy. So that's why having a third party look at it, they're going to ask questions, maybe repetitive questions, the questions that have already been asked before, but they're going to bring items to the forefront that should be dealt with. And if it's not documented, it needs to be dealt with.
Good, great, thank you. That was very helpful.
Before you see your client, you want to gather as much information as you can. So you want to go on the internet and search your client out, find out who they are, what they do, what can you find out on Google or LinkedIn or a corporate site or industry sites, anything that you can do to find out more about them. Because the more you know about your client before you walk in, the better you appear. If you know that he works for uh, XYZ law firm and he's a major partner there and he's involved in this, you can talk to him about those things versus asking him, where do you work? What do you do? You already know that information. So you appear more informed. The more informed you are before you get to your client, the more they're going to like and trust you, because you're not asking what they consider stupid questions, questions you should have already known if you looked up the client. These are all public information stuff. So other general information you're going to have, there's names and dates of birth, occupations, incomes. Income's very important. You want to know their total income because that has a relationship to how much excess liability that person's going to need. I've seen people that live in very, very modest houses have very, very big incomes. So on the outside, they may not look wealthy, but they could be bringing in $1 million or more a year. And in the event of a lawsuit, there's a lot of money to be gotten from that payroll. So you want to make sure that they're properly protected on their liability. You want to learn all the ways to contact them. You want to be able to contact them via email, their home, their work, their cell phone numbers. Cell phone numbers are very important. We learned that critically with Hurricane Sandy, where people had no power, and a lot of people are using voice over internet protocol and other phone systems where if you have no power, you have no phone. So having cell phone numbers is a very important way to get in touch with people. If you need to reach somebody in a hurry, they may be traveling. Email and cell phones are critical. You want to know about family members. You want to know about parents, children, spouses, items like that. You want to know their ages for a variety of different reasons. Ages give you ideas on what items you should talk about. Depending on the parent's age, you might want to talk about long-term care for the parents. Um, you want you want to know where they're living to make sure that they're properly protected. You also want to know if there's going to be any inheritance from the parents. So this client that may not be wealthy at the moment may be instantaneously wealthy. So you might want to look at recommending more liability than this person would normally be buying, because down the road they are going to be getting assets. And it would be really bad for somebody to end up with a judgment against them, even though they don't have any money, but then down the road they have the money and then they lose it because of this lawsuit. Um, Children you want to know about, you want to know where they're living, what they're doing, where they're going to college, whether they live out on their own, to make sure everybody's properly protected. You want to know if they're doing any unique types of items. What do people do for fun? Sports, hobbies, activities, travel, organizations. I spoke to you a little bit about travel. Organizations is very important. Many people are on volunteer board of directors. What they don't know is the possibility that their personal assets could be at risk being on a board of director. If that board of directors gets sued, you want to make sure that that board has directors and officers insurance. For people that are very wealthy, you can recommend personal directors and officers insurance. And what that is that's directors and officers insurance that goes in excess of the directors and officers insurance that that board has. Think of it this way: if there's 10 people on the board and they have $2 million worth of directors and officers insurance, each person is really only protected for $200,000. For somebody who's worth 10 or $20 million, that's not a lot of coverage, and you can get your own coverage. You do have to jump through a lot of hoops to get it, and you have to provide a lot of paperwork, but it could be very good protection. Um, Sports, hobbies, activities. If the person likes to do sailing and boating, okay, do you own a boat? Okay. Boats are extreme liability issues. Many people get injured on boats. And I'm not even talking about those fast boats that would water skiing. I'm just talking about boats in general. Boats are wet and slippery. People can fall and knock themselves out. They can fall overboard. Very, very big issue. Um, Sports, again, this has to do with a variety of different reasons. If they do fairly mundane sports, it's not that big a deal. If you have to somebody that like runs or something like that, that's not a big deal. You have somebody that skis, then that travel evacuation program might be very important for them, because if they hit a tree somewhere in the middle of nowhere, they want to be able to get out of there and get to a good hospital that can treat their situation. Um, Also, if they travel a lot, there's a variety of different programs in reference to protecting their travel plans that they can buy. Normally, they would get that from a travel insurance agent, but items that you can recommend to them. And we spoke about board of directors. In reference to their personal information, you want to know if they're married, when they were married, if they were divorced, when they were divorced, what's the situation there? Is there still alimony, child support? Is there protection for that? Is there life insurance that protects those items? Um, you want to know about health problems, because that's going to affect your recommendations. There may be some things you can recommend. There may be items that you can't recommend. If there's a history of Alzheimer's in the family, it would be very important to recommend an item like long-term care insurance. Also, in reference to doing any financial planning, health problems can create problems with life insurance and disability insurance. You want to make sure their wills and trusts are up to date and current. We've got many people that say, yes, I have a will, I have a trust, I have all that stuff, but it hasn't been updated, and tax laws have changed dramatically in the past couple of years. You also want to know about inheritances, and that's, as I spoke about before, in reference to they may not be wealthy now, or they might be wealthy, but they might be super wealthy once an inheritance hits. And you want to talk about wealth transfers. Are they at the stage of life where they're actually creating trusts for their children? So you want to make sure that their grown children are properly protected, because there are assets there. Here's where you find out where the real money is. So you want to talk about their investments, and depending on how detailed you want to get, you might want to see their statements so you can know exactly how they're invested. If you're going to do some portfolio analysis and asset allocation, you'd want to know all of that. If not, you want to know generic numbers. How much do you have in 401k and IRAs? How much do you have in regular investments? So that's your choice on how you want to go after that one. You want to know about businesses they own, because that can create exposures. You want to know how they're owned. Are they LLCs? Are they S corps? Are they corporations? What different types of companies do they own? What are their responsibilities? You want to know about all their locations that they own or rent, regardless of whether it's vacant land or in another country or anything, because everything needs to be protected for liability. So you may have a client that has a location here. He rents a place every summer for his out in the Hamptons. So you need to advise him that he needs to get that on his liability policy, so that that person has liability out there. Now, most policies do provide protection worldwide, but if you have some type of long-term lease, you want to name that location on your policy for that period of time when you're leasing it. Your autos. Most autos are personally owned. Some people may have their autos owned by their company. So you want to see how those autos are owned. Even with company autos, if they're driven personally, and most company-owned autos are driven personally, we strongly recommend people put them on their excess liability policy. And the reason behind that is the fact that many commercial auto policies are covered for the named driver. So if they're out somewhere and they loan the car to their child, that child may not have the proper insurance. Even though the person owns the business, they wrote the policy, they're a named insured, their children may not be listed on the policy. So we always recommend people putting their commercial autos on their personal excess liability policy. Watercrafts. Many high net worth people start owning watercrafts in LLCs or trusts or items like that. Their concept behind it is to protect from the liability exposure. That does provide some liability exposure, but it doesn't completely protect them, because if somebody's injured on a watercraft, they're going to sue the owner of the watercraft and the person that invited them out on the watercraft. So that watercraft needs to be listed. That LLC needs to be listed on that excess liability policy for that person to be properly protected. Trust assets, you want to know about those. Most trusts can't be breached if it's a good quality trust, but you want to know about them because it does provide an exposure to the client that with all his other assets, in addition, he has these trust assets, so we can't breach the trust assets, but we can wipe these other assets out on a liability claim. So we can go after bigger assets than we would normally be able to do if this trust didn't exist. You want to make sure that, like I said, there's liability on everything, and you want to know their total net worth. That's the starting point for excess liability.
Brian, one of the things that I imagine could occur in that initial conversation is that the client says, "Why do you want to know all that information? I just want to make sure my homeowners is okay." How would you respond there?
Well, a lot of things intertwine together. Your homeowners protects you for liability. That's one of the items that's on your homeowner's policies. When if somebody trips or if somebody drowns in your pool, there's going to be a lawsuit. The lawyer is going to look into you, and they're going to find out what homes you own, what assets you own, what businesses you own, what autos you own, what water. They're going to find out all this stuff. And then they're going to go, okay, this guy's worth like $10 million. So let's go for 10. If I don't know about all these items, I can't make the proper recommendation to protect you from what a lawyer is going to find out in a lawsuit.
Yeah.
And that's really what it boils down to. All I'm trying to do is protect you. You may think of it as just your homeowner's insurance, but it's your asset protection insurance is really what it is, because there's liability on there. And liability provides a buffer between the lawyer and all your cash and all your art and all your jewelry and all your homes and all your cars and all your watercrafts. So if I don't know about all those items, I can't protect all of them.
Good.
Usually at that point, people go, okay. But then if they're not willing to give you that information, then is this the type of client that you want to work with? Because you want to work with somebody who likes and trusts you. And if after that explanation, they're not going to provide the information, then they don't trust you. And I can't work with a client that doesn't trust me.
Very good point.
We spoke about this a little bit before. You, the financial planner, are part of this client's team of advisors. So there are times when you are going to have to work with the CPA and work with the lawyer and work with the property and casualty broker. And there's two reasons for you to want to work with the CPA, lawyer, and property and casualty broker. One is it gets you more entrenched in being in the team as part of a team player. You don't want to knock other people out. You don't want to start bringing in another CPA. You don't want to go, oh, you don't want to work with them. You want to work with my guy. You don't want to do that, because then all of a sudden that's going to create the CPA go, no, 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 no. You want to work with my financial planner. So you want to be part of a team. You don't want to be a lone ranger trying to shoot everybody. And as you get to know these people, you may get referrals to their clients. So it's a networking opportunity, because not every financial planner does a proper job of analyzing. Some of them are just pigeonholed into, okay, my job as financial planner is to work on this person's assets, and they see assets as cash, money market, investments. They don't see assets as home, art, jewelry, and then what protects all that? Liability. So, and then with the property and casualty broker, you can make them look like a star by providing better information for them to advise the client. When somebody owns a business, you want to learn as much as you can about the business, because again, this is going to help you actually refer stuff to either somebody you know or that property and casualty agent. You might be able to get him in on this person's business insurance just by saying, you should have your property and casualty agent review those policies. He might be able to make some good recommendations, especially if you're not commercially savvy, and most financial planners generally aren't, because it is much more technical. So you want to know about uh, the name and address of the business, the nature of the business, what it does, how they're involved, their tax status, how long it's been around for, who are the owners. You want to know who the owners are, because maybe you can get referred to them. So maybe you can use this person to get to another high net worth individual by having a friendly invitation to their friend and co-owner of the business. You want to know the market value of the business, because that gives you an idea of the size and the revenues. You want to know if there's a buy-sell agreement. And a buy-sell agreement, also known as a partnership agreement, is an agreement that says, if you and I are partners and I die or become disabled, what's going to happen to the business? How does my family, or how do I get my money out of the business? And many people have partnership agreements, but many of these are what's called unfunded agreements. And what I mean by that is there are two sudden instances where a person needs to get out of a business. One is a partner dies. Second is a partner becomes disabled. Now, when the partner dies, it's pretty cut and dry. You're either dead or alive. So if he's dead, got to do something with the business. Now, the family is going to want the highest value for their share in the business. The partner, the still living partner, is going to want to get away as cheap as possible. So the buy-sell agreement actually has a calculation in it on how that value is going to be determined. And that's very important. Now, in reference to death, most people would buy term life insurance to protect that exposure. Just having a buy-sell agreement isn't enough, because if a partner dies, you got to be able to buy that partner out, or you have to sell the firm or fold the firm or whatever, but you've got to do something. And if you don't have the money readily available to buy them out, then you've got to take it out of cash flow, or liquidate part of the business or sell part of the businesses to somebody else that you really don't want to be a partner. So by buying life insurance, you can have it what's called a funded buy-sell agreement, which means person passes away, you have the money, here you go, I take the shares, we're all happy. Disability is just as big, if not larger, of an exposure, and one that's even less protected. In a buy-sell agreement, you will have wording in there that says, if a partner is disabled and can't do their job for X amount of time, and it's normally the standard is 12, 18, or 24 months. Most people go with the 18 months because 12 is rather quick and 24 is rather long to be sitting on somebody who is not generating income. You don't want to get kicked out of your firm too early, but if you are permanently disabled, you don't want to have to wait forever to get your money out. So you can actually buy specific disability buyout insurance that is triggered to match the buy-sell agreement so that payments will start to be issued to reimburse the firm for that firm's payment to that disabled partner. That way that partner can be bought out without it being a financial burden on the firm. Because imagine you got two people that are partners, they're equal partners, they work their tail off just as hard. Now one's gone. The problem being is you've got to try and create income to pay that partner's family off, but now half of your workload is now on you. So now you got twice as much work to do that you know you can't do at this point. So you have to bring in somebody else. You got to pay them. You got to pay him. Basically, you run out of money. So it's very important to do. And in reference to the business, you want to see all the insurance that's in force. You want to review that, make sure that's properly designed. Now we're going to start talking about personal locations, homes, condos, co-ops, apartments, vacation locations, vacant land, items like that. All these locations, you want to know who owns them, how they're used, how the lease is set up, who are the named insureds, and who are the actual owners of the location. So who owns them, who's named on the policy, and who needs to be insured is the person that uses it and the person that owns it, or entity that owns it. And that's very important, especially as somebody has more and more locations. Many times they will have different usages. Their kids could be living there. They could have bought, I've got clients that have bought condos for their kids while they went to college because they thought it was a good investment. They had to pay rent anywhere somewhere, so they just bought a place. They figured in 4 years they'll sell it. So you want to make sure everybody's properly protected there. In reference to the construction of the home, you want to know when it was built. You want to know the construction type. Is it a wood frame constructed building? Is it a masonry type building? What style of home? What's the square footage? Square footage is very important because you want to be able to kind of look at what the square footage is and how much the replacement cost of the home is. I've seen people that have very large square footages and very small replacement costs. And one of the things that causes that is they bought the insurance a long time ago. They've done a renovation. They've done another renovation. They've updated this. They've updated that. But they've never told their insurance company. So they had a home that was 2,000 square feet, and now that's 4,000 square feet. But it's only insured as a very low-level 2,000 square foot home. You want to know if they have alarm systems, and you want to know when they updated them last. We've seen many people that have alarm systems that they're getting an alarm credit on their homeowner's policy, but they've updated their alarm. They've put in water leak detection. They've put in cellular backup. All these create extra credits that they can reduce somebody's homeowner's policy premium. So you want to make sure that the insurance agent gets a current alarm certificate to make sure that they're getting all the credits. If your client has a generator, some companies actually provide a discount for having a permanently installed backup generator. And most people don't know that. You get a house that's 5 or 10,000 square feet, they're probably going to put a backup generator in a house like that. And they put it in, they don't think anything about it. Their agent doesn't ask them, do you have a backup generator? And all this time they could have gotten a credit. So it's important. I did speak about renovations. Whenever somebody's going to renovate their home, their insurance company must be notified. If the insurance company is not notified, the insurance company could deny providing coverage for that additional coverage that's needed, even though the client has technically replacement cost. Renovations have to be told. The insurance company has the right to know what they're insuring, to know that it's properly insured. Landscaping. This is a sticking point. Many times people have a lot of money in their landscaping, and there is extremely little coverage on any homeowner's policy for landscaping. And up in the Northeast, there isn't anybody that sells additional coverage for landscaping. There are people that do sell it in the South. So if you've got somebody, what I call below the Mason-Dixon line, that has a very fancy landscaping, you can actually recommend that they insure that landscaping coverage. Because if a storm comes through and blows down their $5,000 or $10,000 tree, they're not going to get any money from the insurance company, or they're going to get very little money from the insurance company for that tree. So you can be a hero by saying, oh, you know, you've got this beautifully manicured garden and koi pond with all these exotic flowers and stuff like that. You know, you can get that protected. Oh, you mean it's not protected? No, it's not protected. So that's an important item that you can bring up to somebody. Other structures. Other structures on a homeowner's policy is designed to ensure any other buildings or items that are on the property that are not physically connected to the main home itself. So, for example, a detached garage, a pool cabana, a tennis changing room next to their tennis court, the tennis court itself, the pool itself, the fence, all that items. You want to make sure they're properly protected. And you also want to make sure that if the person has flood insurance and they have other structures, they may actually have to get a flood insurance policy for that other structure. And we've found this out over time, that a flood policy will cover a detached garage. But if that detached garage has a guest house as part of it, then there's no coverage for it, and it needs to have its own separate flood insurance policy. And that's a very big problem to find out after the fact. We found that out not for one of our clients, but for somebody we were doing a review for. They had a house that had a guest house. He had insurance on his main house. That main house flooded before we were brought in, and he went to put a claim on the main house and the guest house, and the insurance company said, sorry, that garage is not covered because it's got a guest house. There's no coverage for it. We would only cover it if it was a regular garage. So these are all things that you find out over time. I mean, I've been in the business 25 years. I'm still learning stuff. When a client does a renovation, they may get extra credits after those renovations are done. During a renovation, they're going to remove a lot of credits. If it's a pretty big renovation, your client's going to lose their alarm discount. They may have to increase their deductible. They're going to have to provide a insurance certificate for the contractor to the insurance company. And if it's a knockdown and build from scratch, you're going to have to get a brand new policy, what's called a builder's risk policy, which is another word for that is a course of construction policy that is designed to ensure a building that is being built. And you also want to make sure that the person has enough insurance to rebuild that building, because you're not going to go back every 3 weeks and change their coverage. You want to make sure they have enough coverage from day one so that they're properly insured so you don't have to go back. Guaranteed replacement cost, that's why renovations are such a big problem, because guaranteed replacement cost only comes into play in the event the insurance company knows the exposure that they're insuring. If they don't know that there was a renovation, for all intents and purposes, the insurance company is saying, well, you didn't tell us, the policy says you have to tell us, we're not insuring that. So we'll give you what was there, but not before the renovation, but not the renovation because you didn't tell us about it. You didn't give us the opportunity to inspect the location, the opportunity to determine what is the correct replacement cost, which basically means we were under insuring your location, which means you were paying a lower premium than the exposure that we had, and that's unfair to us. Sound reasonable, Dick?
Yes, absolutely.
Personal property. You want to think of personal property as everything that you brought into that place. Another way I tell people to think about it is, if you could shake that location, everything that moved is personal property. Everything that stayed still is content, is building. So if somebody's got a built-in wall unit, like a library with built-in shelving, permanent shelving, that is part of the building. If you've got a freestanding bookcase, that's personal property. Wall-to-wall carpeting, part of the building. Area rug, contents. So it goes along that way. Now, most homeowners policies will protect your personal property for a set amount, usually somewhere between 50 and 75% of whatever the building is insured for. And normally, that is enough coverage for somebody. Where we see an issue is condos and co-ops, and we're going to discuss that in a little bit because you actually pick your own limits. So we'll discuss that in a little bit. What is limited? There are several items that are limited on policies. Some of them really don't matter. Like on a homeowner's policy, there's actually a limit for grave markers. Really doesn't come into play for too many people having a limit on grave markers, but it is in a policy. But the ones that do come into play is sometimes there's a limit on art, antiques, collectibles. There is always a limit on jewelry. There is always a limit on silverware. There's always a limit on guns. So if you got somebody that collects guns, they got to be scheduled. There is many times a limit on breakable items. And you want to see what's excluded. Sometimes when age or notoriety increase the value of an item, replacement cost doesn't come into play. And when you talk about age or notoriety, you have a client that has a 1780 dining room table. Age definitely plays a value into that. And that definitely increases its value dramatically. That same size wood table you might be able to buy for $2,000 or $3,000 or $5,000 or $10,000, but that table, because it's from 1880, may be worth $50,000. So you have to read exactly how their policy says replacement cost comes into play. Loss of use. Loss of use comes into play in the event of a claim and your client's location gets damaged to the point where they can't live there for a period of time, whether it's a night, whether it's a month, whether it's a year. Depends on how big the claim is. With Hurricane Storm Sandy, a lot of people were out of their location, but a lot of people were out for a variety of different reasons, so not everybody got loss of use. A lot of people were out because there was no power. No power under most policies is not going to trigger this loss of use because it's not a claim. But if their home is damaged by the storm, it may or may not trigger this claim. Depends on whether it's flood damage or not, and whether you had flood insurance, and flood insurance doesn't cover loss of use, so that's a whole nother story. Flood insurance is a whole nother nightmare. But let's say your client's house gets damaged because in the storm a tree falls on it, and they can't live there until that damage is replaced, or the house burns. You can't live there until it's replaced. Loss of use is going to provide a location for that person to stay in an equivalent status to what they are living in now. So if you've got a person that lives in a $250,000 house, they are not going to be set up in the most expensive Hilton.
Brian, a quick question about loss of use and the example of the recent storm in the Northeast. So a lot of people suddenly discovered that something that they thought they might be insured for isn't. Would that tend to cause insurance companies to broaden or narrow offered coverage in the future?
They're probably not, I wouldn't expect companies to broaden. And I have not seen any companies narrow their policies, because this is like, it's a rare occurrence for this catastrophic an event to happen. But it did happen in New Orleans. It did happen here. Flood damage, like most of these people were displaced by flood, especially out on the island and the Jersey Shore. Most of them were displaced by flood. And the problem is flood insurance doesn't have loss of use.
Right.
Okay, so, or nothing of significant value.
Loss of power, I think, surprised people. There were people who 2 or 3 weeks out still had no power, and in effect, their homes were not habitable because of that, but there wasn't a claim, therefore there wasn't coverage.
Correct. And that's one of the issues, because you lost. Now, if this happened in the summer, it wouldn't have been a big a deal, but it happened in the end of October into November, where it was cold, so people could not live in their homes because there was no heat. And that was a big issue, and we did have to deal with explaining to clients that it is unfortunate, but their loss of power is not a covered issue. And that is a problem. And sometimes it's hard to explain to people that not every single item is covered. And sometimes there is no way to protect it. But we do recommend generators.
Yes.
Generator
Good.
solves that loss of power problem. So loss of use would provide coverage for someplace to stay, the additional costs associated with meals. So when you eat at home or wherever you normally eat, you're going to have a cost associated with that. So the insurance company is going to deduct that number from your cost of eating out. If you normally do laundry at home and you have to do laundry out, you get expenses for that. A variety of other types of items. So it's basically the additional cost associated with you not being able to live in your house is what loss of use provides. Liability. This is the most important area of somebody's policy, and generally the least looked at part of somebody's policy. On a homeowner's policy, you're going to have $300,000 in liability, $500,000 in liability, maybe $1 million in liability. That's your base, or what's called primary liability. The first thing you want to do, particularly if there are several different agents involved in writing the property and casualty, is you want to make sure that each policy's liability limit meets the required limit for their excess liability. So you might have a client that has a Chubb homeowners policy and a Chubb excess liability policy in your state, and then they might have a vacation home that's written in California or Florida or the Grand Tetons or Colorado or something like that by some other agent. You want to make sure that that policy meets the liability limit of the excess liability policy because you don't want to have a gap in your insurance, and we've seen that several times. And also you want to look at the auto to make sure, because most excess liability policies on the auto require 250,000 per person and 100,000 per accident, and we've seen people with car insurance in other states where they have 100,000 per person and 300,000 per accident, so they have a couple $100,000 gap in their liability coverage that they would be awful mad about having to pay, and there would be little to no recourse for them because nobody's got a comprehensive review. I mean, they'd go after everybody in the world, but who knows what they would get protected for. So the last thing you want somebody to do is have a gap in their liability coverage, because those gaps usually start at 6 figures, and that's not a good place to start. I mean, if somebody doesn't have enough contents coverage, they might have a little bit of coverage gap, but somebody has a liability gap, the first gap starts at about $100,000. That's not a good point to start at. You want to make sure that their policy provides coverage for what's called personal injury, which is libel and slander, just in case somebody actually says the wrong thing to somebody. It's not on every policy. Sometimes it's an endorsement. You want to make sure it's on there. We spoke about charitable boards and D&O, so I don't think we need to go over that again. Employment practice liability. If your client has household help, there's a variety of things that are needed. Workers' comp is one item, and disability, state disability is another. Now, depending on what your state requirements are, it depends on whether you have to have it or don't have to have it. These policies are normally inexpensive, so they're generally good to get because it protects the client, because most people that have household staff are not poor, so they do have exposures. And most of the people that work for these people are not rich. So if something happens, they need to wait. They find a way to protect themselves, and they find some lawyer that will create a good lawsuit, and the client has to deal with these issues. Employment practice liability is also thought of as sexual harassment or wrongful termination. Even if the suit is not justified, the client still has to protect themselves. So they can buy employment practice liability insurance if they have household staff, and then they can have protection in this area. In case they fire somebody because they're not doing their job, and the person comes back and I was fired because there were advances made and I refused them and whatever. Or I was fired because of this reason, or some other discrimination issue. So you always have to be careful in reference to those items. Medical payments. This is part of liability, and it's on all homeowners policies. Medical payments I consider a please don't sue me part of the policy. If I'm over your house and I'm out by the pool and I trip on the concrete patio and I break my arm on the chair, I don't want to sue you because you're my friend. You don't want to have to come out of your pocket to pay my medical bills because I have a high deductible plan. The insurance company will pay medical bills depending on the company. Some companies are $5,000, some are $10,000, some go up to $25,000, with the idea to avoid a lawsuit. That's the whole idea behind it. If there's a lawsuit, medical payments doesn't come into play and they go through the lawsuit. But this is kind of like a please don't sue me part of the policy. Insurance company will pay the medical bills, done, over, no discussion. Very simple. But that's why it's such a low number, because if it's over $10,000 in medical bills, they're going to sue you anyway because it's a pretty big injury and something really bad happened. Deductibles. This is an area to look at because this is an area where your client can save money. I had somebody that I did a review for. We ended up taking over their policies, and part of the review we looked at the deductibles. And they had a home out in the Hamptons on Long Island in New York, and the premium on the home policy was $17,000 a year. and they had a $100 deductible. I'd never seen a $100 deductible in at least 15 years. I'd never seen a $100 deductible, especially on a $17,000 premium. So I told the client, I said, if I change this to a $10,000 deductible, I can save you $7,000 in the first year. Does that make sense? And they're like, how quickly can you change it? Because $7,000 in 1 year, in 2 years they save $14,000. They technically have no deductible. And this is a client, to give you an idea, they had a $50 million fine art schedule. So obviously a $10,000 deductible is not that big a deal. They can financially absorb that issue, especially if they're saving $7,000 a year to do that. So in reality, in the first year, they have a $3,000 deductible. And in the second year, they have a negative $4,000 deductible. So it was a no-brainer. The way we look at deductibles is, how much can I save by going to the next deductible? If my premium's $5,000 and I have a $2,500, if I have a $1,000 deductible, by going from a $1,000 deductible to $2,500 deductible, I'm going to save money. Okay, I'm going to increase my exposure by $1,500. So I want to see how many years is it going to take me to save that $1,500. If I can save that in 3 years or less, so if I can save $500 a year on my $5,000 premium, which you're probably going to be able to, if I can save that $500 a year, in 3 years I save my $1,500, I recommend the client increases their deductible to $2,500. If it takes between 3 and 5 years to save that difference, you should think about it. Depends on how your cash flow is and depending on how you feel in reference to deductibles. If it's going to take over 5 years, it's probably not worth it. Same thing as you go to the next deductible. How much can I save? How long is it going to take me to recoup that exposure? You can be a big hero to a client by saying, looks like you got good assets, you got money in the bank, you got a low deductible, you could save really good money by increasing your deductible. When's the last time you put in a claim? And the client may say, I've never put in a claim. Perfect target for being able to save a lot of money for the client, look good, and provide them the right protection without being overinsured. Because somebody that's really wealthy, no reason to have a $1,000 deductible or even a $2,500 if they can save the money. I mean, I have clients that have $5,000, $10,000, $25,000 deductibles, and that's because they make financial sense to have that deductible. Some policies, companies like Chubb and Fireman's Fund, many of them will waive the deductible if the claim's over $50,000. So if it's a really big claim, the insurance company feels, you've gone through enough grief, we don't have to charge you a deductible also. So if it's over a $50,000 claim, many companies will actually waive that deductible. Condos and co-ops, these are very important because a lot of these, the client has to pick their own coverage. And a lot of times the coverage is picked wrong, specifically on co-ops, because those are ones where they're very misunderstood. Condos are a little bit more understood because the person understood that with a condo, I own from the sheetrock in. So they understand they have to, everything that they can physically see, they have to insure. And that could be anywhere between $150 a square foot to over $500 a square foot, depending on your location and the quality of construction. That's what's called the additions and alterations. Some people call it building and improvements, but additions and alterations is really what it is. On a cooperative, the person owns undivided shares in the building. So they technically are renting the apartment, and they have what's called a proprietary lease. The proprietary lease will tell them what they're responsible to insure, but most of the times they're responsible to insure anything that's been changed since the unit went co-op. And most of our clients have renovated their units, or they've been renovated 2 or 3 times since the unit went co-op. So for all intents and purposes, they're responsible for everything. So it actually almost gets treated the same as a condo. You got to insure from the sheetrock in or from the lath and plaster in, depending on how old the co-op is. So that is one thing that's very important that most people have very, very underinsured, is the additional alterations on condos and co-ops. Personal property, another big issue, because again, they pick this. And a lot of people say, my furniture's old, this, that, and the other. The insurance company is going to replace new for old. That 10-year-old couch, you can't go out and buy a 10-year-old couch, or at least the insurance company's not going to go out and buy a 10-year-old couch. They're going to replace that couch with a current couch. So you have to have enough personal property coverage to replace everything in that unit with brand new items, all the way down to socks and underwear and pots and pans and food in the cabinet. So you want to think of all those different types of things that they need to. And we have a home inventory that we can also email you that is very, very detailed and would help your client. We actually normally recommend that they start from the back forward, because that's where the more expensive items, because usually they'll get tired of filling it out after a period of time. But at least it gets the expensive items taken care of.
Ryan, do you recommend, in terms of home inventory, that a homeowner would take an iPhone and its movie camera function and just go through the house and narrate at least the big and valuable items?
That's a very good way to handle it, especially if they're don't want to fill out the inventory report. It's a quick way to get that done, but then you have to get that file somewhere else.
Yes. Good.
You don't want to have that file on your iPhone that
Right.
gets damaged in a claim. You want to make sure that that file is stored somewhere else, so if that iPhone dies, you have that. If it gets if the file gets corrupted, you have a backup copy. It's very important.
Good. Thank you.
Loss assessment. As part of an association, condo or co-op, or homeowners association, you could possibly be assessed for either damage to the condo or co-op common areas or work that needs to be done. You can buy loss assessment coverage as part of your policy that provides protection for that. Loss of use, we spoke of, it kind of works the same way. It's actually kind of more important on a condo and co-op to make sure you have the proper loss of use, because your values are many times lower. So you want to see if you can get what's called actual loss for your loss of use versus a dollar limit, because a dollar limit may be very restrictive. Additional items in coverage, and these just are the same whether you're talking about a house, a condo, a co-op. There's two different types of coverage, and I discussed this a little bit in the beginning. One is called all risk, one is called named peril. All risk coverage means you're covered for all types of claims unless it's specifically excluded in the policy. Named peril coverage says you're covered for these 10, 15, 20 different items that are listed in the policy. If it's not listed in the policy, you're not covered for it. You want to have all risk coverage because that puts the burden of proof on the insurance company, where it has to go back and go, where you can go back and say, tell me in the policy where it says I'm not covered. Because if I'm covered for everything, unless it's not covered, unless you can show me where it's not covered, then I'm covered. Where it named peril, the insurance company can come back to you and say, okay, where does it show that you're covered for that claim? And if you can't find a place where it says you're covered, then you're not covered. So it changes where the burden of proof is on a questionable claim. For example, a deer jumps through your window and damages your house. Are you covered? And if you have somebody who lives out in not necessarily the boonies, but in the suburbs, They could have an animal, a raccoon, something come into their house and damage their house. And it may not be covered on a named peril policy. You'll have a better chance of that being covered on a all risk policy. But there may be an exclusion depending on the policy. So you need to look at it. Dwelling replacement cost. Very important to look at. Some policies have what's called guaranteed replacement cost. Some policies have replacement cost. Policies that have replacement cost normally say, we'll pay, if it costs more to rebuild the building than the insurance that we are providing, we'll pay up to 20 or 25%, depending on the policy, more coverage. Provides a little buffer in case there's a spike in building costs or somebody didn't estimate it exactly right. So that's one thing. But you really want guaranteed replacement cost, which means it says regardless of how much it costs to rebuild this structure, we're going to rebuild it. And that's most important when there's catastrophic events, when building costs spike because there's 100 homes destroyed, but there's not enough builders and there's not enough lumber to replace all those buildings in one shot. Like this is going to be a big problem out in Long Island, where those 100 houses burned to the ground, where they couldn't even stop them from burning. That's going to be very expensive because they all need to be rebuilt at the same time. There's a limited amount of contractors, and there's going to be no low bidding around. Everybody's going to be whatever they can get for it. So costs are going to escalate. It's going to be hard to pay the labor involved because there's only so many people that can do the construction. So labor costs are going to go up because they're going to be bidding for labor, which is going to change the replacement cost. So, and in reference to replacement costs, it's so important that you inform the insurance company of any renovations so that they inspect the house so that you can be properly insured. Most policies automatically provide replacement costs for personal property. So that's normally not that big an issue. But again, you have to worry about items of certain values, collectibles, antiques, artwork, jewelry, silver, items of those nature, which could have limitations on them. Rebuilding to code is also very important. The older somebody's home is, the more important this is. Building codes change all the time. So what was to code before may not be to code now. For example, very simple items. Building code may now require that you have hardwired smoke detectors versus battery-operated smoke detectors. The home that you had battery-operated smoke detectors. But to rebuild, you have to have hardwired ones. The insurance company is going to replace what you had. But if you have rebuilt to code, they're going to pay that additional cost for those hardwired smoke detectors. That's just one example. Upgrades in wiring, ground fault interrupted circuits around wet areas are important. Hallway size dimensions, possibly moving of the house because it's not within code of distance from a property line. So there's a lot of different things that may cause an additional expense. Mold. About 8 or so years ago, mold got to be a very big problem. There was a big case down in Texas with a famous person. Their home got infested with mold. There was big problems. Mold is around naturally, so mold is basically excluded from all homeowners policies, but you can buy that coverage back now. For somebody who has a home that they're not in all the time, mold is critical because the chance of having water damage and then mold developing on a home that is not lived in daily is exponentially higher than somebody's home that's there all the time. But you could still have it in a home that you're there every day, because you could have a water damage claim, it could get cleaned up, everything gets put back. 6 months later, all of a sudden you realize that your walls are black because they didn't do a proper job of cleaning up after the moisture. They didn't get all the moisture out. So you can buy additional mold coverage. As the homes get larger and larger, They have more equipment to run them. That equipment gets fancier and fancier. We're insuring a house now that it's a 15,000 square foot house. It has 9 air conditioner handlers. They have a pool. They have a computer system that runs the house. You can actually buy equipment breakdown coverage that will insure the equipment that runs the house from if it breaks down. So it's almost like a warranty for it. Water backup is another item that you want to be protected for. Water backup is when water backs up through the sewers or drains, or a sump pump fails, or items of that nature. That's when water backup comes into play. Very important to have. Most companies do limit you. Sometimes you can buy additional coverage.
Ryan, we've just about come to the end of our hour and a half. I think perhaps we'll stop here, and next week we'll pick up with a special exposure insurance. One thing I want to encourage students to do is, if you have questions that we haven't somehow addressed in this part one of property and casualty, be sure to post them in the forum, and we will attempt to get answers to those questions to you. So, Brian, thank you very much for helping us through this very detailed, somewhat complicated area of property and casualty. I always learn something new, and we've been doing this for 3 or 4 years now. So we will look forward to seeing you next week,